High-income Californians need more than a generic financial plan or a retirement contribution. A strong financial plan connects investments, taxes, cash, equity compensation, real estate, liquidity, insurance, and estate planning into one coordinated framework. Most financial plans tell you to max out your retirement accounts, save more, diversify, and invest for the long term. The problem is that for high earners, those decisions are table stakes. A generic financial plan can miss some of the biggest opportunities and risk by focusing mainly on pre-tax returns. For high-income earners, California tax can be a major planning factor. California taxes ordinary income at rates as high as 13.3% in 2026. It does not provide preferential treatment for long-term capital gains. It does not provide the same federal real estate bonus depreciation. There is no California 529 deduction, no HSA deduction, or QSBS exclusion. And California does not provide a credit for taxes paid to foreign countries. For high earners, the federal SALT deduction may phase back down to $10,000 in 2026. Tax strategies that work at the federal level or in other states may not work the same way in California. In this video, I'll cover 5 planning areas when coordinated can help improve after-tax outcomes, reduce risk, preserve flexibility, and support better decisions across your financial life. Hi, I'm Aaratee, founder of Aaratee Financial. I've spent more than 20 years at the intersection of finance and technology in Silicon Valley, including leadership roles at major tech companies and leading financial institutions. On this channel, I break down practical investing, tax, and wealth management topics for high-income Californians. Today, we're looking at what a real financial plan looks like when your financial life includes high income, California taxes, equity compensation, taxable investments, real estate, and business income. We will cover why Californians need a different kind of financial plan, the 5 planning areas a high-income California financial plan should integrate, common mistakes high earners make, and finally, a simple framework for California financial planning. A basic financial plan usually answers questions like, am I saving enough? Can I retire on time? How should I invest? Do I have enough insurance? Or do I need an estate plan? These questions are still important, but for high-income Californians, the bigger issue is that almost every decision interacts with taxes. A bonus may affect estimated tax payments, RSU vesting may increase ordinary income and create employer stock concentration, ISO exercises may increase AMT exposure, a rental property bonus depreciation may create federal tax deductions that California does not fully recognize, requiring 2 separate real estate depreciation schedules. A Roth conversion may look less attractive if you plan to move to a different state in the future. A large taxable portfolio may create capital gains, tax loss harvesting opportunities, charitable planning opportunities, and estate planning issues. In other words, a financial plan cannot be built in silos. A tax plan affects the investment plan affects the cash flow plan affects the retirement plan, and the retirement plan affects future tax brackets. And estate planning decides how your wealth is ultimately transferred to your loved ones or charities. For high-income Californians, a financial plan should be an integrated strategy for building, protecting, and eventually transferring wealth in a tax-efficient way. A strong financial plan has 5 areas working together. Number 1 is cash flow and liquidity. This means understanding what you actually have available after taxes and not just your total pre-tax income. Your income may include salary, bonus, equity compensation, investment income, business income, rental income, or income from other assets. The goal is to understand how much cash is truly available after taxes and how much should be allocated towards investing, emergency reserves, debt reduction, real estate, education, or other lifestyle goals. It gives you a picture of what comes in, what goes out, and how to allocate it. Number 2 is tax strategy. For high-income Californians, tax planning is not a once-a-year activity. It should be reviewed throughout the year, especially when income is variable. This includes federal tax, California tax, estimated payments, capital gains, stock compensation, business income, retirement contributions, Roth strategies, charitable deductions, tax loss harvesting, and real estate deductions. For example, if you have a business, contributing to a solo 401k can reduce taxable income. The point is not to avoid taxes at all costs, but to make tax-aware decisions before the year is already over. Number 3 is investment strategy. This is not just about what to buy, but what to hold, in which account, with what tax impact, and for what purpose. This includes cash management, asset allocation, risk tolerance, public market investments, private markets, real estate, taxable accounts, tax advantage accounts, and portfolio rebalancing. Asset allocation is what you own. Asset location is where you own it. The same overall portfolio can produce a very different after-tax result depending on where each asset is held. For example, if you like real estate, a residential rental property can offer tax advantages through depreciation, but owning and managing a rental property can require hands-on work. Number 4 is equity compensation and concentration risk. Many Californians receive RSUs, ISOs, NSOs, and ESPPs as compensation. These awards can build wealth quickly, but they also come with tax surprises and concentration risk. A financial plan should have a clear strategy for vesting, exercising, selling, holding, and diversifying employer stock. For example, I've used a covered call strategy for many years to diversify my employer stock concentration. Number 5 is insurance, estate planning, and long-term flexibility. The goal is to protect the household if something unexpected happens, preserve flexibility, and make sure assets are structured properly. A high-income household may need wills, revocable trust, guardianship planning for young children, appropriate insurance, umbrella liability coverage, and eventually estate tax planning. For example, if you plan to retire early, a taxable account may provide more flexibility over retirement accounts. Now let's talk about 6 common mistakes high-income Californians make with financial planning. Mistake number 1, holding too much cash without a plan. Cash is often ignored in financial planning, but it matters for Californians. Many high earners keep large amounts of cash for taxes, a home purchase, business needs, or emergencies. But where that cash sits matters. A high-yield savings account may look simple, but the interest is taxed both at federal and California levels. Treasury bills are different because Treasury interest is exempt from state income tax. For California residents in high tax brackets, that makes Treasury bills and a Treasury bill ladder more attractive as compared to other cash alternatives. This does not mean every dollar should be in Treasury bills. Tax reserves, near-term home purchase funds, emergency reserves, and investment dry powder may each need a different structure. Mistake number 2, focusing only on federal taxes. Now, California tax can change the outcome. Some strategies that look attractive at the federal level may look less attractive when California tax treatment is considered. This is especially important for capital gains, real estate depreciation, equity compensation, business income, business entity structures such as sole proprietorships, LLCs, and S corporations, and Roth conversion planning. Roth conversions can be powerful, but large conversions during peak income years in California can be inefficient. If you're already in a high federal tax bracket and a high California tax bracket, you may be paying tax at one of the highest rates of your lifetime because the amount converted is taxed as ordinary income. Mistake number 3, not having an asset allocation and asset location strategy. Taxable accounts can provide flexibility before retirement age, liquidity for real estate and business opportunities, and favorable long-term capital gains treatment. But they can also create taxable dividends, capital gains, and concentration risk. So have a tax-aware strategy for how your assets are diversified across public equities, private investments, real estate, as well as taxable, tax-deferred, and Roth accounts. This can be especially important if you plan to retire at age 50 but have limited access to your retirement accounts until age 59 and a half without penalties, unless an exception applies. Mistake number 4, ignoring employer stock concentration until it becomes an issue. Many employers accumulate large employer stock positions without a plan for how much of their net worth they're comfortable keeping in employer stock. A rules-based sale plan combined with tax loss harvesting can reduce concentration risk while managing capital gains. Mistake number 5, delaying risk management and hoping nothing will go wrong. Risk management is often a low priority until markets fall, layoffs happen, a business faces a problem, or a family emergency occurs. This includes portfolio leverage, insurance gaps, business or job risk, and estate planning. This is especially dangerous when leverage is involved. Some use portfolio margin loan or complex strategies to create tax losses without fully understanding the risk. A tax deduction does not offset the danger of margin calls, forced selling, or losses that exceed the tax benefit. Risk management should protect your wealth, not just reduce taxes. Your estate plan should also reflect your family assets, beneficiaries, and your overall risk exposure. Mistake number 6, managing everything separately. Your investment strategy, tax strategy, cash strategy, real estate, and estate planning should not be disconnected. A strong financial plan should answer these 5 questions. Question number 1, what is my true after-tax income? Pre-tax income is not enough. The plan should estimate federal tax, California tax, payroll taxes, AMT exposure, capital gains, deductions, credits, and estimated payments. Question number 2, how much risk am I taking? This includes portfolio risk, margin exposure, employer stock concentration, real estate leverage, business risk, job risk, liquidity risk, insurance gaps, and the lack of an estate plan. Question number 3, where should each dollar go? Each dollar of income should have a purpose. Spending, taxes, emergency reserves, retirement accounts, taxable investments, real estate, business reinvestment, education funding, charitable giving, or debt repayment. Question number 4, which strategies are worth the complexity? Not every tax strategy is worth doing. The plan should compare the tax benefit, risk, cost, administrative burden, liquidity, and long-term flexibility. Question number 5, what needs to be reviewed every year? A high-income household should review the financial plan annually and sometimes quarterly. Income changes, tax laws change, markets change, equity awards vest, companies go public, children are born, businesses grow, and retirement goals evolve. The financial plan should evolve with the household. For high-income Californians, durable improvement comes from coordination across investments, taxes, cash flow, equity compensation, real estate, insurance, and estate planning. This is how you move from financial complexity to financial clarity. If you found this helpful, please subscribe for more videos on tax-efficient investing, tax planning, and cash management for Californians. And if you want help to think through your own cash management, tax management, and portfolio management, you can learn more on our website, auraefinancial.com. Thank you for watching, and I'll see you in the next video.